Hi, this is Bill. I wanted to take some time to go over the Tire City forecasted income statement and balance sheet. It was really good getting back together yesterday. I just felt like maybe we had rushed through this a little bit towards the end of class. So I wanted to give everybody an opportunity to see this again, and I thought the best way to do it would be with this video. So here what I've done so far is, if you think back to Gemini Electronics, I've set up a common size balance sheet based on a percentage of sales. And I've followed that through also onto the balance sheet, where these numbers in this column represent a percentage of sales. And you'll see how we can use this to project both our balance sheet and our income statement going forward. So because you all should know how to do a common size balance sheet, I've already set that up for you, and now we're going to go ahead and start projecting sales or income statement and balance sheet for 1996 and 1997. Now we're using a variation of the method that Higgins talks about, which is the percent of sales method. But what's important to note is that you just can't go through and estimate or forecast or project everything just based solely on the percentage of sales. Sometimes there's things going on in a company that will affect like cost of goods or expenses that you wouldn't want to follow the percentage of sales, because things are changing. Say there's an efficiency in the factory, so your cost of goods really should go down over the historical figures, not at the historical figures. Having made that statement, I'll show you where it's not appropriate to use percentage of sales and where you might have to use some other type of calculation to get to your forecasted income statement and balance sheet. So the first thing we always want to do is start with the top line, or net sales. And you can see in this case, the author actually tells you that sales are going to be growing at 20% per year. So really the way to project sales then, this is a real simple way to project sales based on what the author has told us, is just take the previous year's sales times 1.2 to incorporate or calculate the 20% increase in 1996. And then we would do the same for 1997. Take the previous year's 1996, which has already been increased over 95 by 20%, and increase that again by another 20%. Oop, something happened there. It helps if you use the right formula. So there we go. So there we have our sales for 96 and 97. Real simple, 20% per year growth rate. Okay, next we look at cost of sales. And you can see we've been running right around 58%. If you do an average of these, it comes out to 58.2% cost of sales as a percentage of sales. So all we have to do is drop in a formula on our cost of sales, which takes sales times 0.582, or 58.2%. And then, because we're using the same thing for 97, we just copy and drop that formula there. So you can see now that we have cost of sales in 1996 of $16,416, resulting in gross profit of $11,790. I forgot to mention that before I started this, I set up 96 and 97 formats so that all the proper formatting and formulas were already in my spreadsheet. So as you can see here, I had already dropped in the formula for gross profit, which is net sales minus cost of goods sold. Okay, we'll move on to expenses now. And we'll see that we had 32, 31.2, 31.78. So we'll take another average, or look at the trend, and we've decided on 31.7% cost of sales. Again, just drop a formula in here, your net sales times 0.317, representing 31.7%, and you have 8,941 in sales, general, and administrative expenses. And we'll keep that same assumption for 1997 and drop it in there. Depreciation is a little bit different. The author said that depreciation would stay constant in 96, then increase in 97 due to the new construction of the warehouse. Okay? So pretty simple. In 96, because it's going to stay constant, we're going to pick up the number from 1995. The depreciation is staying the same, and this is according to the facts in the case. In 1997, we have $2.4 million in new construction at a 5%. So let's just do a little math here. 2.4 million times 5%, because you're going to amortize this over 20 years, would be 120,000 in depreciation. Although we have to also add back depreciation from the previous year. It's only increasing by this much. It's not the actual increase. So we'll add back 213. And we have a total of 333,000 in depreciation. That includes the existing depreciation plus the 120,000 for the new depreciation of the new facility. Net interest expense is a little bit tricky, and I'm just going to give you the numbers on this because it really involves a circular reference. What happens is you're going to see later in our balance sheet that we're going to use the bank loan, the amount of money that we borrow from the loan, as our plug figure. And that's to get the balance sheet and income statement to balance. And what happens is as you change that number, it changes the amount of interest, then changes retained earnings, changes the bank loans. It goes on and on. It's what we call a circular reference. So rather than go through the calculation on that, and there is a way to do it in Excel, but I don't think it's important to understand it now. You should be able to, if you were doing a projection, you should be able to get these numbers from your controller anyways. But we know that in the end, the interest is going to be 129 in the first year, and in the second year, 116. Okay. When we look at income tax, you see that we have the percentage of sales here, but that's not really the number that you want to use. You should derive an income tax rate based on history, and I'm going to use this cell to calculate it, the percent of sales cell to calculate it. And it would be the amount of income taxes paid divided by the pre-tax income from the previous year. That's what will help you come to an income tax rate. So I'm just going to copy that formula into the next year's. Here we go. And you can see that, and I'm going to color those in so that you remember that those are not percentage of sales, but they are an income tax rate that we calculated by taking the amount of income tax that was paid divided by the net income. And so we look at that, and if we take an average, our income tax over the 3 years has been 43.4% of pre-tax income. So if we look at our pre-tax income here, we'll take in reference pre-tax income times 0.434 to represent the percentage of the tax rate that we've estimated. And I've got a formatting problem there, which I'll correct in a minute. And we'll just carry that forward here as well. And we'll format these properly so that it's not confusing. You always want to keep everything formatted in the same number of decimals and so forth. Okay. Still didn't work. Let's try one more time. Number, we're going to have 0 decimals, and we're going to use the commas for separation. There we go. That looks better. So you can see now that we have estimated our income or net income for 96 and 97. The next thing we want to do is estimate the dividend. And again, here we're not going to use percent of sales. because you don't pay dividends from sales, you pay dividends from net income. So I'm going to go in and I'm going to estimate what the amount of dividends were as a percentage of net sales. And again, I'm going to highlight that to indicate that this is not a percent of sales, but another calculation. You can see that I can just copy this formula now into our other cells. And it looks like it's about a 20% of profit after tax. So 20% of basically net income. So, and this will be important when we calculate our retained earnings later. So here we go. The net income times 20% dividend rate. And we'll just copy this over into 1997. And I hope that you're understanding the mechanics of Excel, but that you're also understanding how the income statement flows and how you would project it going forward. We're going to stop here and create a second video for balance sheet, but this explains how to project out an income statement using a modified percent of sales method.